We are jumping straight into Redwire Corporation today. If you've been watching the markets, you know this name is volatile. We're talking about a 52-week range that runs from, roughly 490 up to an eye-watering 2670.
It's huge range.
Everyone's watching that wild price action, but the real story, the one that matters long-term, is where the fundamental value is.
Exactly. I think that volatility can be a bit of a distraction from the powerful trend that's happening just beneath the surface.
Right.
The fundamental shift here isn't about day-to-day trading. It's the significant acceleration in their contract wins and program visibility.
And these aren't small wins.
Not at all. They are massive external validation. I mean, we're talking about the $44 million DARPA Otter mission in very low Earth orbit VLEO, and then also there's recent commercial deals for their docking systems. That validation, essentially the U.S. government and big commercial players putting serious money behind their hardware, is the primary driver positioning them for huge revenue growth, even while they're posting these serious near-term losses.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. We take your sources and help you find the signal in the noise. I'm glad you're with us.
This is such a textbook example of a high-growth, high-risk aerospace play. We really need to break down the technology moat first because that's the foundation of the entire bull case.
Okay, but before we jump into the details, if you're enjoying this breakdown, make sure to subscribe and hit the like button. It really helps the channel. And definitely let us know in the comments which company you want us to simplify next.
All right, let's build that bull case for Redwire, starting with what makes it special. The core of it is the proprietary IP, the tech moat, that's, deeply embedded in the space infrastructure value chain.
Okay, that phrase, proprietary intellectual property deeply embedded. That sounds like classic tech jargon. For someone listening, what does that actually mean for their business?
It means they aren't just selling a service, they're selling the critical, non-negotiable building blocks that, every modern spacecraft needs. We're talking mission-critical structural systems, avionics, power solutions.
So the guts of the machine.
Exactly. And the moment their hardware is designed into a spacecraft, say a satellite that's going to operate for 10 years, the switching costs for that customer become astronomical.
So you can't just swap it out.
You can't just pull out their sensor or their structural system mid-program and plug in a cheaper competitor. It locks in that market share and creates, predictable long-tail revenue.
That makes the technology their ultimate defense. And on the IP side, this is where it gets really interesting for me. They own the proprietary international berthing and docking mechanism, the IBDM tech.
Right. And the IBDM system is so much more than just a latch. It's a sophisticated, automated standard. The reason it's so key is that it's compliant with the international docking standard, making it central to autonomous rendezvous for these major global projects.
So if it's the international standard, does that mean Redwire basically controls the on-ramp for any future systems that want to link up with big government projects?
That's exactly the implication. We're talking about its role in the International Space Station, the future Lunar Gateway, and critical commercial missions.
Wow.
When a company needs to deliver cargo or transfer crew, they need a reliable, compliant docking system, and Redwire provides that core platform. We saw this translate directly into contracts, like with the exploration company for their Nix docking system.
Okay, so docking is a strong moat. But let's shift to what seems like the real game changer. That $44 million DARPA Otter VLEO contract. This validates their SabreSat platform.
And SabreSat is revolutionary because of its unique propulsion system, which is called air-breathing electric propulsion, or ABE.
Air-breathing electric propulsion. That sounds like something straight out of science fiction. Why is that specific technology such a big deal for VLEO, which is, for those listening, that very low orbit range?
Well, it solves a massive physics problem.
Yeah.
In that VLEO band, there's still just enough residual atmosphere to create significant drag.
Right, so things fall out of the sky faster.
They decay and burn up. Traditional satellites have to carry huge amounts of propellant just to stay aloft, which is expensive and heavy. It's like a swimmer constantly fighting a current.
Okay.
ABEP technology is the solution. It actually scavenges the few air molecules that are up there and uses them as a kind of propellant, a fuel source that never runs out.
It uses the environment as a free fuel source.
Exactly. And this lets the satellites operate for year-long missions in that drag-heavy environment.
And the huge benefit of operating that low is what?
Yeah.
Better pictures.
Lower latency and much, much higher imaging resolution than traditional satellites can get from higher orbits. You're closer to the target. It's a next-gen capability validated by DARPA, which is, the gold standard for high-risk, high-reward tech.
So that tech is now translating directly into massive revenue momentum. Q3 2025 revenue was up a, frankly, jaw-dropping 50.7% year-over-year to $103 million.
And this is the key signal. This isn't a one-off acceleration. Analysts are forecasting, 49% revenue growth in the coming year, which just blows away the industry's 10% projection.
Right.
Their full year 2025 guidance is sitting between $320 and $340 million. It's all driven by that contract momentum.
And we also have to talk about the Edge Autonomy acquisition. This can't be an afterthought. It feels like a really strategic pivot.
It absolutely is. Edge Autonomy diversifies them into autonomous ISR, that's intelligence, surveillance, and reconnaissance, and UAS, or unmanned aerial systems.
So why does a space infrastructure company need a drone company? They seem like totally different worlds.
Yeah. It's about creating an integrated end-to-end national security solution. Think of it like this. Their space assets, like the VLEO satellites, gather high-res data from above. The Edge Autonomy drones operate in the atmosphere, providing that lower-altitude surveillance.
Ah, I see. So it's a complete package.
Exactly. Government customers often need both. And buying them from one integrated vendor streamlines everything. It creates this dual-use portfolio that very few of their small-cap peers can actually match.
Okay, so the bull case is clear. Proprietary tech, massive contract validation from DARPA, and accelerating growth. That's a very compelling narrative.
It is, but the story is only half complete until we look at the bear case. While the tech story is strong, we have to address the financial reality. And this is the core risk for you, the listener. The company is currently free cash flow negative and unprofitable.
Let's get into that, because this is where all that volatility comes from. What's the magnitude of this profitability challenge?
We're looking at some significant losses right now. Trailing 12-month net income is a loss of $268 million. Wow.
Yeah, it's a big number. The Q3 net loss alone was around $25 million, and they had negative free cash flow of about $35 million. The cash is moving out the door.
A $268 million loss? That's staggering. How can any investor look past those numbers, especially when critics are already calling it overvalued?
That is the essential trade-off. And the market consensus is that this is the cost of securing these next-gen contracts and doing rapid acquisitions like Edge Autonomy. The challenge is proving that the massive revenue growth can translate into profitability before they, run out of cash.
And we know the market is absolutely unforgiving if they stumble. The stock is clearly highly sensitive.
Highly sensitive is an understatement. I mean, look at the Q3 earnings disappointment. That, plus integration costs from the acquisition, led to an almost 30% drop in the share price.
In a very short period.
Yes. That's the definition of a high-risk stock. It demonstrates that execution risk, and it ties right back to the stock's high beta, which is around 2.5. So a beta of 2.5. In simple terms, what does that mean for an investor?
It means the stock is dramatically leveraged to the market. If the S&P 500 moves up 1%, Redwire, in theory, moves up 2.5%. But, and this is the critical part, if the market moves down 1%, Redwire gets punished by 2.5%.
Yeah.
That explains that massive 52-week range you mentioned. Investors are punishing any misstep immediately. You are signing up for extreme volatility here.
So given the cash burn and the volatility, what about the balance sheet? Can they support this high-growth, high-burn strategy?
The balance sheet is levered, but it seems manageable for now. They have long-term debt of about $185 million.
That's a burden.
It is, but it's offset by nearly $90 million in liquidity, including $52 million in cash. And management is being smart, focusing capital strictly on high ROI programs like SabreSat. No dividends, no buybacks. They're in pure growth mode.
And there's a key point here about the contracts they're winning that helps mitigate that stress, right?
Yes, that mechanism is absolutely key. The big defense contracts, like the one from DARPA, are typically milestone funded.
So they get paid as they go.
Exactly. The government provides progress payments as they complete certain stages. This supports their working capital and, really importantly, reduces the pressure to constantly issue new stock to fund development.
Okay, so despite all this volatility, are insiders and the so-called smart money running for the hills? Or are they seeing this as an opportunity?
We're actually seeing a strong vote of confidence. There was documented cluster buying from the CEO, the CAO, and an EVP right after that Q3 earnings disappointment.
That's a classic insider confidence signal.
It is. It suggests leadership thinks the market overreacted.
Okay, that's the insiders. What about the big institutional funds?
We've seen significant institutional accumulation, too. One major firm, for example, initiated a new position of roughly 2.2 million shares. It suggests that large, sophisticated investors view the recent drop as a genuine buying opportunity.
So if the big money is buying, how do the professional analysts justify it? I mean, how do they look past a $268 million loss?
They justify it through the enormous potential for operating leverage once the company hits scale. The analyst consensus implies a pretty massive future upside, somewhere in the range of 60 to 115%.
Wow.
The investment community is largely looking past the near-term losses toward an expected, and I should say crucial inflection to positive free cash flow in 2026.
So this all raises a really important question. What specific events should an investor be watching for over the next few months to see if that inflection is actually happening?
Right. We need concrete proof that the financial execution is starting to catch up with the technological success. There are a few key items on the calendar to watch.
Starting with earnings, the next major report is Q4 2025 results, which we expect in early February 2026. And then the really critical Q1 2026 report.
And for Q1, consensus revenue is sitting around $132 million. These reports have to demonstrate two critical things. First, successful integration of edge autonomy. And second, the early successful ramp-up of those large defense contracts. Any revenue beat, especially with even a little margin improvement, will be a huge validator.
And beyond the financials, we have to watch the program milestones themselves.
Absolutely. Look for specific progress updates on that DARPA Otter VLEO program. Hardware delivery timelines, on-orbit demonstration milestones, delays there would be badly received.
Of course.
And any additional major contract announcements are huge catalysts, as they just further validate the tech and expand the customer base.
And finally, there's always the macro picture, especially for a stock this sensitive.
Yeah, any sector-level rotation toward defense and space spending is a powerful tailwind. And if the macro environment shifts toward rate stability or even rate cuts, high beta growth companies like Redwire tend to outperform significantly.
Okay, so that's the lowdown on Redwire Corporation for today. The core thesis really boils down to technology leadership in a high-growth sector space infrastructure. And that DARPA ABIP contract is the critical proof of concept.
Right. The risk is clearly the cash burn, and the stock is going to stay volatile until they hit scale. But the potential reward is a massive re-rating as those contract revenues finally hit the bottom line.
So, the key thought for you to mull over. Redwire's portfolio is now strategically unique. They combine that deep space infrastructure IP, like the docking mechanism and the ABEP propulsion, with autonomous drone technology from Edge Autonomy.
It's a dual-use defense and space platform. The question is, what kind of larger aerospace and defense prime, a company that needs both space assets and terrestrial autonomy, might look at that unique portfolio and see a perfect strategic takeover target in the future? That potential optionality isn't yet fully factored into the price.
If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.